All right, everybody. Thank you all for attending the Planet MicroCap Showcase Vancouver. I'm really excited to close out today's event with our final keynote presentation here. We got Ryan Irvine from Keystone Financial. And Ryan, the floor is yours, my friend.
All right, give me this. I'll put it on here. Oh, you guys are amazing. I will. I'll talk into it. Can you guys hear me? That's good. I tend to yell sometimes, so hopefully we all hear me. It's good. We're good. We're good. So I was going to say welcome to Vancouver, but I think most of you are from Vancouver. But my opening line was, hope you've been enjoying our $20 beers and our $1,000 hotel rooms. But like you're all just probably driving from your house right now, I think. So I think that really applies. I was going to say I have a 250 square foot condo right down the road. I could sell you for $1.5 million if you want to stay farther, but it's not that funny when you're not from here. So, or you are from here. But anyways, hopefully you know what we are, Keystone. We've been in business for 23 years. We're independent advisors, helping our clients build 15 to 25 stock portfolios over that time. Independent means we don't receive any money for our research from the companies. We just get paid by our individual subscribers who subscribe to our research and pay us to find them the best stocks all across the board. We look for small cap companies. That's where we started 23 years ago. But we build portfolios, including the Apples and the Googles and the Microsofts of the world. Now, if it sounds like I'm going to be talking fast today, that's because I've got about 45 minutes of material, so jam into 30, so let's get it going. I got broader market valuations I'm going to comment on in the start here. It's been difficult for us to find growth at a reasonable price broadly in larger cap names for the better part of several years now. We are starting to approach some levels where we see some pockets of value. And in the small cap area, we think we're still being patient, but we think there is value there. We do believe that over the next 12 to 24 months, there will be some great discovery research that'll help you. Hopefully we could do that for you, help you position your portfolios to make outsized gains over the next decade. This is when the real money can be made in a well put together portfolio. Now, broadly speaking, when we look at current valuations, one metric that we like to look at, I've got it here for you, is the Shiller PE. It's a more reasonable market valuation indicator than the regular PE because it eliminates fluctuations of the ratio caused by variations of profit margins during business cycles. We can see here, this is the Shiller over the last 20 years. The ratio reached its highest point in November 2021, right there. That was 47% above the 20-year average, which the 20-year average is around 26.2. This was the highest ratio other than, this is over the last 100 years of the Shiller PE, the highest ratio other than in 1999 at roughly 44. That was in the dot-com madness at that time. So where are we today? That's what we're really looking at. Well, broader valuations today, where is the Shiller? 31.3. Now that PE is 18.7% higher than the last 20-year average. Again, that was 26.2. That's far better than the Shiller PE, far better than the range it hit when it was 38 in November of 44 in November of 2021. But it's still 47% above the PE of the last 20 years. Now, the Shiller PE of note here, if we look back historically, it's noting that it is instructive to point out that it's 79% above the all-time average of 17.4, indicating we are not nearly historically cheap right now. It's better than the peak valuations that we saw, but risk remains in the market. And we really see a bifurcated market right now, and I'll get into that in a second. It's a tale of two markets, a tale in terms of valuations. Now, this here is a chart by Yardeni Research. It actually looks like a plate of rainbow spaghetti to me right now, but it's supposed to be a simple chart there. Really, what it is showing is the disparity between large cap and mega cap stocks represented by the PE here, the forward PE on them, in the red and purple lines respectively. And the small cap universe there is in the green line, and that is represented by the S&P 600 small cap index. I can shout out the numbers on these. The S&P 500 large cap, 18.9 forward-looking PE. The mega cap 8, the largest companies, 28.1, and the S&P 600 small cap is 13.8. So I think you can see where I may be going with that. Of note, though, the S&P 500's gains are powered so much now by the MicroCap 8. You can see 26.9% is the latest influence that they have on the S&P 500. Now, if we drill down a little bit farther into the large cap versus small cap story, this is since 2005. The S&P 600 has historically traded at a premium. So small caps historically trading at premium valuations to their larger cap brethren, if we look at this S&P 500 cap here. But we can see today small caps trade at a significant discount to their small cap or their large caps. Now, again, you can see this on the chart. It's dropped below. It's pronounced and likely a long-term opportunity in quality, growth-oriented small caps. So that is kind of that would be more of our quantitative analysis. The Shiller PE and the valuation gap that we looked at there. Let's take a quick look at some of the qualitative analysis that we do as well. In the last quarter, our analyst team, there's 4 of us that looked at these companies. We went through 3,000 stocks on North American markets, looked at their latest numbers using our growth at a reasonable price model, and we read through their MD&As, and we went through their quarterly reports and select management teams. We interviewed about 50 management teams. So what did we find from that? Well, we also, as an aside, we went through those 3,000 companies. Then we did another report called the Electrification Report. Started with about 400 North American stocks ranging from loosely associated with the electrification segment. EVs, battery stocks, rare earth companies, electrical equipment, grid software, everything, utilities, all across the board. Now, we talked to a good deal of management teams, and I cherry-picked some of the stats, kind of qualitatively, our findings, and I'm going to share with them right now. Now, we found North American manufacturers, and this is speaking generally, have been benefiting from reshoring. They've had higher inventories for their end consumers, which has juiced revenues. We've seen our customers pricing increases. Some they benefited from that. Some input costs decreasing now from the highs. Supply chain issues are easing, and there was some pent-up demand. But there are some risks here when we talk to the C-suite. They're saying essentially what we're seeing there is this can leave a gap. One of the main things that we see is inventory levels are normalizing, and it leaves a gap in quarterly numbers as end customers sell out of inventory for that quarter. Numbers were inflated in 2022 due to inventory builds as basically safety stock for their end customers. Now, we're being cautious here not to extrapolate the 2022 growth numbers as sustainable or a new normal going forward. There is a real potential for some significant step backs in the upcoming quarters over the next year. We have already seen this in some of the companies that we monitor in the Q2 and Q3 numbers that have just been released. Certainly a moderation in growth in many of the manufacturers that saw pent-up demand as inventories were building from their end customers into 2022. Now, other risks we see are continued inflation, wage and input costs. Wage costs are continuing to rise. There was a potential for a reversal of the reshoring that we saw as customers seek prices overseas as the supply chain normalizes once again. Weaker end demand and recessionary fears. What else did we learn from the C-suite? Well, higher interest rates, and we know this, you probably all know this, but they're squeezing profitability. The C-suite, we saw many of these CEOs were caught off guard with the significant net debt companies by the speed and the magnitude of the move in rates. Those with floating rates going from, say, anywhere from 3 to 4% up to 7 to 9% has a meaningful impact on their cash flow. Now, looking just at EBITDA, we're very cautious right now. We want to look at real cash flow in the companies that we're analyzing. Companies have really switched from playing offense to playing defense now, and their cost-cutting efforts, and we see growth suffering over the next year in a number of these companies. Now, we are concerned by the consumer resilience coming out of the recession that we saw, but not so resilient at this point, particularly in Canada, where you see mortgage rates they reset faster than you see in the U.S. Well, the companies that we spoke to worry that the consumer is being squeezed and disposable income is coming down. Now, what do we like though? What did we see? And which companies did we see were very confident? Many of the management teams, well, those were net cash businesses. They're feeling good right now. Companies with significant cash are kind of sitting pretty right now, earning better interest on that cash, but that's not really what we're looking at them for. More importantly, with capital in the equity markets drying up, access to capital, the cost of capital being significantly higher, M&A activity is turning from a seller's market to a buyer's market. We favor companies with strong balance sheets and cash and M&A opportunities over the next 1 to 3 years. We think that's going to open up for some smart companies that have held on to their cash and built up that cash and can use it to buy some businesses that come on sale. So what would we like to do, or what would we avoid today? Well, to start off, I'll talk about that in a sec. We help clients build simple equity portfolios. So we buy the Microsofts and the Alphabets of the world as well. But these are companies with great balance sheets, great businesses. Both those companies set to continue and have been benefiting from AI. Now, we also like companies like Fortinet, a leader in cybersecurity, great balance sheet as well. We continue to own core Canadian growth stocks like Brookfield Infrastructure and Exchange Income. But today we're here to focus on the small cap area of the portfolio. So when we're looking at them, what are we avoiding? We're avoiding debt-heavy businesses, particularly cyclicals. This is where you can really get into trouble. Highly leveraged companies, interest payments are higher, eating into profitability. So restaurants, hotel chains, airlines, furniture, high-end clothing, retailers, and automotive manufacturers. Now, cash-rich, strong, cash-flowing producing businesses with debt, we're not eschewing those. There's some great businesses out there that have debt on their balance sheets that we can still buy today. But it's the companies that don't have the strong cash flow that we're avoiding. Now, we favor, and I alluded to this, cash-rich businesses. These are stocks with net cash positions on their balance sheet, producing cash. Yes, we want them to be able to weather a downturn, but we also want them to play offense and be able to capitalize on it. A couple of the companies in our coverage universe have already done that over the course of the start of this year. We expect that to continue over the next year. I'll give you a couple examples. Dynacor is a company, roughly 40% of its market cap in cash, zero debt. I'll talk about it more in a second. I'll talk about another company today that has 50% of its cash, market cap in cash and zero debt. Another company I'll highlight is Hammond Power Solutions. Huge cash flow position, gone from a net debt to net cash and ready to expand organically. Now, why I highlight this company? Well, it's done tremendously well. It makes us look smart. But mainly I highlight it because it's a good example of a unique company that basically no one else in Canada covered, but we've owned back since the start of this decade, in the 2000s, when this company was essentially two businesses, Hammond Manufacturing and Hammond Power, and it split apart. We chose Hammond Power, and it was at 60 cents today, and I'll show you the stock it was 60 cents today, not today. It was about 18 years ago, but today it's 56.21. Now, Hammond Manufacturing, incidentally, has entered our coverage recently. We think it's a good company, but I'm here to talk about Hammond Power today. They're a leader in the design, manufacture of custom electric engineered magnetics, standard electric type, die-type, and cast resin liquid-formed transformers. And when I say transformers, I'm not talking about Autobots and Decepticons. Sorry, that would be really cool if I was. But what I'm talking about is transformers that are used to step up and step down power, step up to travel over a long distance, step down to be used in your home or applications such as a charging station. Now, as a matter of fact, Hammond's transformers are used at every Tesla charging station in Canada. And I've checked. Every one I go by, I look and find the transformer, and you find the Hammond name on there, and they're there. It's great to see. When we recommended this, again, re-recommended it 7 years ago, or several years ago, sorry. It was in the $7 to $8 range. You can see here. Now, at that time, they traded about 7 to 8 times earnings. We wanted a backdoor way of playing the electrification boom that we saw going forward. Many of the obvious EV plays, the EV car manufacturers or the charging station manufacturers, trading at ridiculous valuations if they had any underlying cash flow. Well, Hammond Power had decent core business and cash flow, but as the world electrifies, the increased need for these type of products was seen, and the stock has moved significantly higher. Now, still after the gains that we saw over the past several years, it still trades at 11 to 11.5 times earnings right now. It's benefiting from growth in its traditional customer market, which would be energy, mining, silica, manufacturing, and data center markets. But there's new opportunities for this company, evolving technologies like EV charging. We talked about Tesla, solar energy, and energy storage applications. The backlog is still at a near-term high. Now, we've taken half of our original position out of this stock. Again, buying at 60 cents, buying at $7. We need to take some profits, but the company has around 600 million in annual revenues right now. We would forecast by 2030, they're going to be in the range of $1 billion in revenue. So it's not going to get there in a straight line, but we continue to own an outsized position right now. We expect it to be more volatile, but we own an outsized position. Now, I'm going to get to a simple concept. Now, this is something I talk about at events that I give, all across Canada. I love to hammer on this point. Warren Buffett, I'm going to say, recently said in the Berkshire Hathaway annual meeting that the majority of gains in his 58-year career were made on just 12 stocks. Now, that's one great stock, great capital compounder every roughly 5 years in his career. And that would be like the likes of Coca-Cola for Warren Buffett. Now, you likely know this, but again, I like to hit myself and everybody in the audience over the head with this point. I think it's therapeutic. Getting hit over the head, I'm not sure about that, but it's a simple concept. And before I get to the 4 stocks I want to recommend today, I'm going to talk about this. Just 2 or 3 great stocks in your portfolio in your lifetime can change your portfolio. Now, it is a simple concept, and it sounds like hyperbole, but it's not. But sadly, you won't hear that from most financial advisors, most financial pundits. The traditional construction of portfolios that many investors use inhibits you from benefiting from truly great stocks. And I'm going to show you how you can make some simple changes to the way you build your portfolio so you can capitalize on great stocks. Now, I put up this chart mainly because the numbers look great for us, and I usually have my associate Aaron with me, and he really needs that. I don't need it as much, but he really needs that. Hopefully you can see that. It looks totally different on here, but anyways, it looks good. So now my point here is this is over a 20-year period. I picked out 5 great stocks. It's similar to what we've seen in Warren Buffett's research or in his career as well. And I'll go back to talking about when he said 12 stocks over 60 years. This is how he powered his outsized gains. Now, if you added 1 or 2 or 3 of these portfolio or stocks to your portfolio over the last 20 years, you'd have a tremendous wealth effect in that portfolio. Now, we had a number of clients talk to us about investing in a couple of these companies. These are the straight numbers: $20,000 invested about 14 years ago in Boyd, 2.4 million today. 50,000 invested in Expel. A client just talked to me about this. Now, this is when 5-6 years ago, Expel was trading in the $1.20, $1.40 range. Had $1 million portfolio. So take 20 stocks, divide that by the $1 million portfolio, 50,000 in each. Now, the entire portfolio 5-6 years ago was $1 million. One stock in that portfolio now is worth $1.6 million. It just shows you how much a great stock can propel the gains in a portfolio. Now, it allows you to make a lot of mistakes because in the small cap arena, you will make a lot of mistakes, but you have to have these winners in your portfolio. Now, the question should come to mind, a couple of them. How do I find the next Expel, Boyd, Hammond Power, or Water Furnace in my portfolio? What do these great businesses have in common? Number 2, how do you construct a portfolio to capitalize on Expel, the Boyds, the Hammond Powers, and Water Furnaces of the world? Well, as far as the profile of a stock goes, you should be looking for, to really keep it simple, great cash flowing businesses, good management with skin in the game. They trade at reasonable valuations and have long-term growth paths ahead of you. We literally give 2-hour seminars on how to find these companies. I don't have time for that today. But what I can do for you is I can tell you the next part, the answer to the next part of the question, because it's a little simpler. How do you construct that portfolio to benefit from these companies? What you can't do is construct your portfolio in the way a traditional advisor typically does that. Buying 50 to 100 stocks in your portfolio. It's just not going to work that way. I have 5 to 10 minutes, so I think I'm going to speed it up and get to those companies. The bottom line is, this is Warren Buffett. He says, don't diversify. concentrate your portfolio, invest with conviction. That's what Bill Gross says here. And how many stocks should you own? Well, about 20 stocks. We say 15 to 25, depending on the size of your portfolio, but that's where we believe the sweet spot is in your portfolio. Anything greater than that is diversification. That's as funny as it gets in finance. Laugh it up for us right now. Thank you. Okay, 15 to 25 stocks. Let's get to some of those stocks. Dynacor. Now, this is a company that we've recommended for a number of years now. Like I said, about 33% of its market cap is in cash. But what is this company? They're a miller, not a miner. They purchase ore from government-registered producers in Peru right now and process it at their wholly owned facility in Peru. Now, how do they make their money? It's a really simple business. It's a margin between the price of ore processed and the market price for gold. The higher the margin, the better. Throughput also helps them. The more ore they're crushing and putting through their mill, the better. A higher gold pricing environment helps them. We're seeing that right now. It encourages more small-scale miners to put through and bring them the ore to be crushed. Now, here we go. These are our recommendations. Currently trades around $3.15. We recommended it between $1.40 and $2. Still recommend it today. Fair value is about $4.20. Pays a good yield. I'll talk about that. High geopolitical risk in the business. Why do we like it? 11 consecutive years of profitability. That's unheard of in the gold segment. Very strong balance sheet, 33% net cash self-funded. This is the cash position since 2019. It's gone from around 22 cents per share to about $1.05 per share right now. Dividend growth stock, we love that. We consulted with the company, had them actually institute a dividend. We love getting paid to hold companies that we own. You can see it started around annualized basis around 2 cents. Today, it's around 12 cents, and we expect it to be upped again at the end of this year. Payout ratio is about 25%, so has a lot of cash to keep funding. Reasonable valuations, growth and diversification plan in place. This is the midterm growth. You can see back from 2018 to 2019, all of those figures going up in the direction we like. There was a pause in terms of growth over the past year, but now, again, this year growth has started, 20% in revenues, 27% EBITDA, 71% earnings per share. And that's real earnings per share, not an adjusted figure. We like to see that. Investment thesis here would be strong dividend. Balance sheet for growth. Now, this company, over the next 3 to 5 years, they have 1 mill in Peru. We'd expect them to open up another one in Peru, in the north. They're in the south right now. Other Latin American countries they're looking at, and West Africa. This is the stated goal of the company. Their existing plant just increased 16%. It can increase up to 600 tons per day. Trades at low valuation, 6.8 times our expected EPS this year, 4.4 times cash out, and just 8 times earnings. Adding back the cash gets you at 4 to 4.25 target fair value, essentially. Strong gold pricing environment. Let's look at the next company here. Polaris Renewables. We like this company. Have owned it for about a year now, since it traded roughly in the $13, $13.80 range. Bought lower when it sunk down to 11. It's $14.75 today. Great dividends. Good last quarter. Tremendous growth there. 37% revenue. Adjusted EBITDA and earnings per EBITDA per share up significantly. Guidance 57 to 61 million this year, up 31%. Cash flow was up 19% on a per share basis. A lot of that growth is coming from their binary unit that they installed in Nicaragua. Now, the story here is to diversify away from Nicaragua, and that's what we're seeing the company do. As you can see, the near-term growth path for this company up to 2024. This is all funded, and we'll add 12 to 18 million in EBITDA, which is great. But this gives you some, it quantifies you how they can get from where they are today. We expect around 60 million in EBITDA this year, which is significant growth over last year, to the 100 million in EBITDA by 2027 or 2028. Again, this past year, 43 million. You add 17 million from the new binary unit and the new acquisitions they made, you get 60 million. Then you're going to add some new production to get you to 20 million in EBITDA. Following that, all they got to do is acquire 20 million, and you've got to about 100 million in EBITDA, which would call for significantly higher valuations from the business. There's our thesis: good growth, long-term growth path ahead of it that is reasonable and fundable. Net debt right now, based on next year's EBITDA 2.3, so relatively reasonable. Attractive valuations there, as you can see. And fair value is 21, trades around the $14 range right now, pays a 5.7% dividend, 5.45% dividend. It's 5.7 a couple of days ago. InMode is a company we like. Got to be very quick on this one. There's an aging population. We like demographic plays that trend into that. This company, minimally invasive and non-invasive aesthetic and medical treatment solutions in the U.S. Just picked up coverage on this earlier in the year, $35. Trades around 38, 39 today. No yield. We think it's significantly undervalued right now. Why? We love track record of long-term revenue growth. We see it here. Projected growth this year. EPS growth as well. We like both of those things, marrying them. Now, our investment thesis, they're a global leader in aesthetics. Strong track record, high margins and profitability. 7 years as a public company, you saw there. Growth in underlying earnings and revenues every year. 20% growth in revenues, 22% growth in non-GAAP earnings in the last quarter just reported, and the guidance was up for the year. Cash per share trades at around, like I said, $39. Cash per share is $7.57, no debt. PE is 13.5, lowest in its peer group. They are a foreign issuer status, so it adds a level of risk. This is the last company I'm going to look at. I'm going to go really quickly. Specialty pharma company in licensing products in Canada. They own the rights to a product called Epuris, which is an Accutane substitute that is in the severe acne realm. What's better about their product is essentially with Accutane, you got to eat a meal before you take the drug. With their product, Epuris, you can eat it on an empty stomach. So, but that's not the only reason. That's the core cash flow that we like. We just recommended this a month ago around the 375 range. Traded at 419 yesterday. They just announced a substantial course issuer bid, I think, on Friday. So the stock is about 435 today, significantly undervalued. Our investment thesis, 36 million in cash. That's half the market cap in cash. Has core products that have good cash flow, shielded by some tax losses as well. Near-term growth, though, it's about flat from the core business. What we see is them deploying 70 million over the next 2 to 3 years to add inorganically to their growth. They think they can buy this cash flow, these cash-producing pharma assets, at around 5 to 6 times. We'd say it's probably 6.5 that they're going to have to pay. The long-term organic growth comes from one product I'll highlight, and right before you eat, you really want to hear this. It's about nail fungus. It's absolutely gross. We see that on Canada, there's commercials all over TV. It's about an $85 million market. There's one product in the market. That's why you see the ads. You can't advertise the name of the drug, but that's why you see the ads, because there's one product dominating the market. Now, if you can believe it, if you get nail fungus, which I'm sure nobody in this room has, of course, but if you get it, the treatment takes a year and you have to paint it on your toe, for example, every day. Well, their product that they're in licensing that now has been licensed into Europe, you paint it on once a week. So that's 52 times a year as opposed to 365 times a year. I think that's how many days in a year, right? So we think 3 years from now you'll have good growth from the existing, or flat growth from the existing business over the next 2 to 3 years, supplemented by inorganic growth by M&A. And then 3 years out, you could get a boost by organic growth. If they didn't have this organic kicker 3 years out, that tells me I'm on time. Okay. So if they didn't have that, we wouldn't be interested, but we do like the growth that they have organically 3 years going forward. There's another plaque psoriasis product that's promising as well. Current valuations, quite cheap. EV to EBITDA is 3 times. Price to FFO is 4.8 times. We don't have a fair value on it right now. We are waiting till they make an acquisition so we can run those numbers. We think they're undervalued in this range right now. They have, like I said, just a substantial course issuer bid was announced on Friday, buying about $6 million worth of shares, not lower than $395, not higher than $475. So there are some disclosures. Hopefully that helps. And thank you. And everybody, go have a drink. Get out of here. Thank you very much.